The silver market is on the verge of what could be a once-in-a-generation boom. You see, commodities move differently than stocks. When they begin new trends, those often last several years and lead to gains of several hundred, even 1,000%. And once these moves begin, little can stop them. Unlike stocks, which can be sidetracked by an earnings miss or CEO unexpectedly stepping down, physical commodities trade purely on supply and demand. And when it comes to precious metals, that demand is not coming from retail traders. The buyers are governments, central banks, and financial institutions with near limitless access to capital. And right now, silver is poised to rise by 300 to 500% over the next few years. Silver has been largely overlooked for decades. It has always taken a backseat to gold, but for the past several years, gold has taken a backseat to Bitcoin. This put silver on Wall Street's back burner. But while most investors have been focused on tariffs and interest rates, silver has quietly marched higher. In March of last year, silver broke out from a 3-year consolidation. It is up 86% and climbing, but based on history, this is just the early stages. Stepping back to a monthly chart and taking a big picture view, you'll notice that silver is on the cusp of breaking out of a 45-year cup with handle pattern. And silver, when it does move, does so in a big way. The price soared more than 1,100% in the early 2000s. This, of course, pales in comparison to the 3,496% rally that took place in the 1970s. So why such extreme moves? One word: manipulation. The silver market has been plagued with price manipulation for decades. In the 1970s, the Hunt brothers, a couple Nepo babies who inherited their daddy's oil fortune, cornered the silver market. They started buying at $2 an ounce. By 1979, they had accumulated over 100 million ounces of gold, close to a third of all the silver in the world. And the price had shot up to $25 an ounce. Their silver stockpile was worth more than $3 billion, an unfathomable figure at the time. They got so giddy, they started borrowing money to buy up silver futures, adding massive leverage to their outsized position. By 1980, silver was approaching $50 an ounce. Then the regulator stepped in. COMEX introduced Silver Rule 7, designed specifically to curtail the Hunt brothers' excessive buying of silver futures contracts. It placed heavy restrictions on buying on margin. They had to put up more money to hold these contracts, and their ability to cover these loans began to slip. They were hit with margin calls and forced to sell. Silver plummeted from $48 an ounce to $11 an ounce in 8 short weeks. Their billions of dollars in silver morphed into over $1 billion of debt. In the end, they were banned from trading in the American commodity markets by the CFTC, forced to pay $130 million in damages, and eventually filed bankruptcy. In 2020, J.P. Morgan Chase paid a $920 million settlement for manipulating precious metals markets between 2008 and 2016. The Department of Justice discovered their traders would artificially move silver prices through a tactic known as spoofing. So basically, they would place these huge buy and sell orders to create the false impression of supply or demand and then cancel the order before they were executed. They would also do something known as tamping. They cause sharp price drops during low liquidity periods like the morning open. So they dump a bunch of futures contracts or paper silver, as they call it, on the market. This would push prices down and then allow those institutions to buy up physical silver at low prices. Then there are the bullion banks like JPM and UBS, who often hold large net short positions in silver futures. But today, silver prices are on the rise. Demand is high as central banks and foreign governments have begun fleeing the dollar and accumulating physical assets like gold and silver instead of government bonds. It has become crystal clear that U.S. government spending will never be reined in. While we don't have time to go into it in this video, what you need to know is that this is unequivocally going to lead to massive inflation going forward. Inflation devalues the currency. And so no one wants to hold U.S. government bonds that represent U.S. dollars if those dollars are going to decline. But Let's dive into what's going on. I'll show you a couple of charts and see the technical picture as it lays out here in silver. So this is a weekly chart of silver futures. And again, I've laid out this really clean breakout that took place in early 2024. You can see the big rise followed by this textbook shallowing pattern as price approached this $26 area, breaks through, and has nearly doubled over the last 18 months or so. But we really want to step back and look even bigger picture. Now, I'm going to go all the way back to a monthly chart, and we have reliable data. Let me put this in log scale. We have reliable data on silver prices back to about 1970. Maybe some shops have earlier data, but we don't really need all that. When we look back here, one, you're going to see the big moves. I mean, there's that 3,000+% rise back in the 70s. There is the 1,000+% rise in early 2000. But look at this. Look at what we're seeing. This is a textbook cup with handle pattern, and it is formed over a 45-year period. And when this does eventually break out, as we're on the cusp of doing, it is well within reason that we could see silver up in the $200 to $300 an ounce range and potentially higher. Now, there's actually more to this. What you're looking at here is the gold-silver ratio on the top and just the price of silver at the bottom. So on top, the gold-silver ratio, and you can Google this, it just represents how many times the price of silver gold is. So in other words, if gold is $100 an ounce and silver is $1 an ounce, it's trading at 100 times the price of gold. And generally, if we go back and just look at several decades here, we have this, I guess, data back to like 98. But over the last 20 or 30 years, generally it's in kind of the 60 to 80 range. It may get a little bit below it, may get a little bit above it. But what you'll notice is any time this ratio gets out of whack, when the gold-silver ratio gets too high, especially up here above this like roughly $95 or $100 level, you get a big rally in silver to catch up. So here in 19 and 20, the gold-silver ratio got to be, meaning gold is 125 times the price of silver. Way too expensive in relation to silver. And pretty much to the day, look down here on the bottom of the silver prices. Silver went from $12 an ounce to $30 an ounce over the next 6 months. Again, it gets, really close. Got to like 97 right here, so pretty darn close to it, but much higher than the multi-decade mean. And once again, silver just got too cheap, and it rallies from 18 all the way up here to around 30. Now, the same phenomenon just took place again. Earlier this year in April, the gold-silver ratio, once again, for the first time just second time in the last couple of decades, breached the 100 mark. And so starting there, and that was just right here, this is just April of this year, a couple of months ago, started this rally in silver. And silver prices have surged. So far, it's about 40% over the last 5 months. But again, as we look back at these historical rallies in silver, it doesn't run 20 or 30%. It doesn't tack on a nice little base hit. It runs hundreds, sometimes thousands of percent, because these moves formed over years, decades often. Once that volatility unleashes, once the spring releases its energy and all that massive demand comes off the sidelines and starts buying, we can see multi-year runs in commodities like silver. And the last thing I want to show you is how it compares over the last few years. So what I've gone here is 3 assets. In red is the S&P 500, and then I've made gold, yellow, and silver. Hopefully that makes sense. And so you look at the last couple of years. Let's look at like the last 5 years. You can see how silver has underperformed. It needs to rally just to catch up to gold where it should be over the last 5 years. Because if we look over the last 1 year, you can see they're pretty much in line. Over the last 6 months, it's starting to outperform silver as a little bit. And over the last 3 months, it's really starting to outperform. So what you have is this near-term rally taking place in silver, trying to catch up to this historical gold-silver ratio. We have demand for precious metals like gold and silver from financial institutions and central banks and foreign governments who are trying to get out of dollars. We have a backdrop of inflation coming in, and I don't care how much they try to pretty it up. They just raised the debt ceiling by $5 trillion. They're not going to stop spending. Democrat, Republican, they're all going to do it. It's been this way since 1991. It's never going to stop. Let's just face reality. The debt is going to continue to rise, the deficit will continue to widen, and eventually the system is going to break. You're going to see massive inflation, dollars are going to be near worthless, and gold and silver, maybe Bitcoin, who knows, are going to skyrocket in value. And you have all of this happening when you have this massive 45-year technical picture coming to unfold in silver. Now, in the daily charts, you can see a pretty steady rise. What I try to do with these type of trades is kind of dial in as tight as I can. And the best setup, we saw this in gold a year and a half ago, is when you have kind of a breakout on the daily chart, a breakout on the weekly, a breakout on the monthly, and all these forces combined, all this demand for multi-time period investors send a big shot higher. So like the silver, you can see the big compression it took here. That's the early 2024 breakout we talked about. It made a decent run. Based out again. You can see another breakout that took place kind of here in June. And then if you really dial in close, you could even look for these shorter term patterns like is formed here across August and September, where once again you get the shallowing pattern, it tightens up, it compresses, it breaks out and starts to run. So what I like to do is try to dial in on these daily charts, find a decent entry somewhere here, 40, 41 bucks a share. Then once I've got some profit working, I will kind of step back and manage it on a bigger picture, maybe on something like a weekly chart, trailing a moving average down here. And then the goal being, I'm building a position here in this kind of $40 range. I want to be in it for a longer term move. And then hopefully we get this pending breakout through $50 an ounce. This is going to play out over a couple of years. I add the positions that comes through here to new highs, and then you've got you're adding on each of these breakout points or pullback areas, building into a position in silver, and you've got a sizable position as you get this multi-year run into 150, 200, 250 an ounce, potentially beyond. So that's what I'm seeing in the silver market. Listen, don't put all your eggs in one basket. Don't bet the farm on this, but I'm a strong proponent of having some of your assets in physical precious metals. I know Bitcoin's hot. I know woulda, shoulda, coulda bought it in 2008 and been retired. I understand all that. But Bitcoin fails in some areas where gold and silver do not. If the power's out, you have no Bitcoin. If the internet's out, you have no Bitcoin. That is not really a catastrophe asset versus silver coins and gold coins and bullion are always going to be those solid physical assets. They have been currency metals for thousands of years. I don't see that stopping anytime soon. And these are the go-to inflationary risk hedges that historically have done extremely well in times of crisis. Now, if you haven't already and you've made it to this video, hit the subscribe button right over here in the corner. That way these will pop up in your feed and you won't miss the next video update.